Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be the mayor himself, the governor of the great state of Texas, the guy who owns so much real estate in Texas. We've given him that honorary title, Mr. Michael Becker, but he is on another due diligence assignment. So we are pleased to have in the professor himself, Mr. James Eng. James, how are you?
Good. Thanks for having me, Paul.
James, what's going on in the Old Capital world these days?
I think the biggest thing is our annual conference is coming up. So October 24th and 25th. I was actually just listening to Warren Buffett and Charlie down at their little conference or shareholder meeting down in Omaha. And it seems very similar to our little conference, I think, is we sort of get everyone together and just have a good time. So I don't know if we'll have 1,000 people, but that's the goal. So if you haven't booked your ticket to come on down to Dallas and see us for our once-a-year event, that would be a good one to come down for. That's
great. That is always a great event for networking and learning a little bit more about multifamily. Would you say it's for new investors looking to get into buying their first deal? Or is it really for the second, third, or fourth deal? Or is it for limited partners? Or is it for everybody?
I think everybody will get something different out of it. I think there'll definitely be some of your experience indicators who have, 4 or 5 deals under the belt, and they're there to really meet limited partners and also meet listing brokers to buy their next deal. But then also new guys who maybe need a partner will also be coming out and meeting some of those experienced investors, and also just get to know a little bit of the lay of the land here in Texas in terms of what deals are out there and what's coming down the pipe.
Fantastic. Well, in the podcast today, we have one of our friends that we've known for a long period of time. We've done a lot of business with. And this is going to be a little bit of a different podcast because we're really not going to talk about ownership in apartments. We're going to talk about financing of apartments. And where we've sat down before with this gentleman, Peck, about probably 2-3 years ago. And we kind of talked a little bit about how to finance multifamily properties that have been smaller properties. Remember, the lender, us, the bank, we're bringing in 75 to 80% of the money. So get to know us, get to know some of our rules, exactly what you need to do to get financing of apartments. So in the podcast today from Red Capital is John Darrow. John, how are you?
I'm doing great. Thanks for having me, guys.
Well, thanks for coming in, John. We appreciate that. John and James and I, we all do a lot of business together. The Old Capital Group does a lot of business with John Darrow. So he is an underwriter for Red Capital, and he's very knowledgeable about what's going on. And we're going to try to pick his brain a little bit to give you a kind of a sense of what it takes to get into multifamily financing, to get your transaction completed without having a lot of stress about it. And so we're going to go into the small balance Fannie Mae and Freddie Mac type of loans. So Fannie Mae and Freddie Mac type of loans. So I'm going to bring it over to James, and we're going to start asking John some questions to help you understand apartment financing.
Maybe to start out, and we'll just sort of lay the foundation here between Fannie and Freddie, maybe give us some of the common characteristics of the property and the borrower that Fannie and Freddie will finance.
That's a great question. So Fannie Mae and Freddie Mac both report to the same regulator. So what that means is the common characteristics will be items like non-recourse. You're going to have 5, 7, 10, 12, 15-year fixed rate loans. They're going to be willing to go up to 80% on acquisitions in certain marketplaces. They are nationwide lenders, so they'll lend everywhere, and likely they will be the best lender in certain markets that are more secondary and tertiary. To an extent, they will provide IO.
They probably don't even require a banking account with Fannie Mae, right? Because a lot of banks require an operating account. That is correct.
Yeah, so they will not require any sort of assets to be held in any sort of specific bank.
Loans assumable?
The note is assumable. In terms of collateral, they're going to largely be looking for stabilized properties. So stabilized, cash flowing, We are talking 90% occupancy. Certain instances, they'll go down to 85, but typically we like to think about it 90 for 90. So 90% occupancy for an average of 90 days. They're really looking for, everything from the A to B to C quality assets, and they have no problem with going to, I guess the best way to put it is the secondary and the tertiary markets, primarily looking for the stabilized assets, though.
So I'm taking notes right now. So let's handle the Freddie Mac positives, and then we'll handle the Fannie Mae positives, and we'll kind of walk and talk through it. So on my notes that I'm writing down, just want to make sure everybody understands, is that with the Freddie Mac small balance loan, again, what's the loan amounts between?
On the Freddie Mac small balance, it's from $1 to $7.5 million.
So these are loan amounts. These are not sales prices. So sales price would be typically, say, 1.25 or $1.3 million sales price for $1 million loan amount. And then again, you can go to a 25 or a 30-year amortization on the deal, 25. And typically small regional banks may only go do 15, 20, and on the high side, 25, and that's on a case-by-case basis. If the balance of the loan is at maybe 65 or 70%, they have levers and switches they pull. So they'll give you a longer amortization if your leverage is lower. Freddie Mac can also do interest only, whether it's 1, 2, or 3 years of interest only. Again, that kind of can depend on the area of the country, the size of the population in that area, the quality of the property itself, and a little bit more about the ownership group too. One of the biggest things is non-recourse. Again, these loans compete against the bank loans, the ones that you walk down to your small regional bank down the street. Non-recourse is not something that's going to be on their menu. One of the biggest things is recourse. Not only do we want to have the collateral, but we want to have interest in your balance sheet. So a lot of people have heard me talk in front of large groups that when I talk a little bit about non-recourse versus recourse, and when I talk about recourse, that's when I ask an audience member, can I borrow your wallet? And the audience member says, yeah, and gives me a wallet, and I grab that wallet and I put it in my front pocket. So that is what a bank loan is all about. Not only do they take interest in the asset itself, but they take an interest in your wallet, your balance sheet. So in case there's ever a deficiency balance, they have your wallet to pay grandma, who they borrowed money from in the deposits, to make them whole. Fannie Mae and Freddie Mac do not require, typically, they don't have recourse conditions, so typically non-recourse. And we'll talk a little bit about the carve-outs and what that means too. So that's an important thing. James, anything to add to that?
No, I mean, so when we're looking at Freddie, what would you say is some of the advantages of, let's say a $5 million deal comes in and they're looking Fannie versus Freddie. Let's go through the advantages specifically on the Freddie Mac side that maybe is unique to that Freddie small balance program.
Great question. All right. So both Fannie and Freddie have large appetites. They want to be in every market and bidding on every deal. With that in mind, what we tend to find is that Freddie will lend itself to certain instances a little bit better than Fannie, and Fannie in certain instances a little bit better than Freddie. So one of the biggest characteristics that we see where Freddie will outshine is in a top market deal. And the reason that is because Freddie does very well on a 5-year fixed rate loan. And what that allows us to do is also in that top market, we are underwriting to a 120 debt service coverage ratio. So if the name of the game is maxing your proceeds, Freddie Mac is always going to be the way to go. And when I say top market, think Chicago, LA, San Francisco, Dallas, Miami, New York, and Boston. So one of the biggest areas, again, just to reiterate, where Freddie will outshine Fannie is going to be in that top market where you're looking to max out the proceeds and you need the ability to underwrite to a 120. Fannie Mae, on the other hand, is typically they're always going to be underwriting to a 125 DSCR. So you can see just in the difference between 120 versus 125, if proceeds is the way to go, you're going to be looking towards Freddie Mac.
And so, the closest top market to us is Dallas County, which we're sitting in now. But if you go a little bit further west out to, let's say, Fort Worth, is that considered, do they look at the entire MSA or is it just Dallas County?
No, it's going to be just Dallas County.
Okay.
They'll take a look if there's an individual instance, but Dallas County is, pretty much hard and fast.
Okay. And then let's flip over to the Fannie small balance side. When would somebody, same deal, $5 million, stabilized deal, why would they go Fannie versus Freddie?
So Fannie does very well on the 10 and 12-year paper. So when I say 10 and 12-year paper, I mean a 10-year fixed or a 12-year fixed, and all of these loans amortize over 30 years. Fannie will also do very well in instances where you may be looking for a little bit additional IO if you're willing to go a little bit lower on LTV. Freddie, they have a pretty good box of, hey, you can get A, B, C, or D, and it's going to cost this, this, and this. Fannie's a little bit, they allow you to tailor a little bit more if you're willing to sacrifice LTV or if you have a better coverage ratio. So Fannie will do better in that instance. Fannie will also entertain instances where you may be looking to do a little bit of work on the property. And by that, they will allow you to do a what's known as a supplemental. So after the loan has been funded, you can come back and take an additional level of proceeds out, or you may even be able to finance upfront some of the costs associated with the renovations. So those are typically the areas where we see Fannie outshine Freddie Mac.
And so on my paper here with my notes, I've got Fannie Mae in one column, Freddie Mac in another column. And I'm just going to say one thing that's going to trigger, and you maybe give me how Fannie treats it and how Freddie treats it. And then I think that'll give people a little bit better idea. Let's talk about when you lock the interest rate for both these programs.
Great question. Freddie will lock your interest rate. And when I say interest rate, your spread and your treasuries, they will lock it when you sign the application. The only thing that may potentially affect your rate down the line is if some sort of the underwriting changes, or if you say, hey, I don't want as much IO. That would be the only time that your rate potentially would change down the line. Fannie Mae, however, does not lock your rate until you go and have your internal committee review and your commitment. So we're talking about a difference of probably about 45 days. So Fannie Mae, in summary, they lock right before you close. Freddie, you are locked once you sign the application.
And when I say sign the application, you mean sign the application and pay the application fee?
That is correct.
And what typically is an application fee for a Fannie Mae, and what's an application fee for a Freddie Mac loan?
So on the lender side, we try to keep the costs associated with doing these loans as little as possible. So upfront, we are taking a deposit to defer. What it really comes down to is the appraisal costs, the engineering costs, and the lender legal costs. And what we don't receive upfront, we'll bill back at closing. So at Red, we typically look for about $8,500 upfront. And that primarily goes entirely to just third parties and lender legal.
Yeah, that doesn't go to anything, doesn't go to processing the transaction. This doesn't go anything to the loan documents itself. It's just a deposit up front to get the wheels going.
That's correct.
To get your third parties going too. So application fee is pretty much the same between the Fannie Mae small balance and the Freddie Mac small balance. Again, and I don't know if we've talked about it, again, loan sizes for Freddie Mac are from, again, what?
1 to 7.5.
And then Fannie Mae?
It's 1 to 6 million.
Okay.
On the small balance side on Fannie, but you
Correct.
can go up higher. Okay, and then so we talked about, when your interest rate is locked, but then, okay, between the two programs, when is the deal or how is the deal actually approved? So when does approval come in and how's that process?
That's another great question. So with Freddie Mac, we will underwrite the deal entirely internally. And then what happens is we send it to Freddie Mac and they will underwrite the deal themselves and send it back to us with the Freddie Mac commitment. So call it about 4 weeks or so internally, and then Freddie takes another 2 weeks. So, 6 to 7 weeks before you see the Freddie Mac commitment. And you have two different sets of eyeballs. You have our internal credit eyeballs, and then you have Freddie Mac's. On the Fannie Mae side, everything is delegated to be underwritten internally. So the difference there is that there is no Fannie Mae approval as long as the loan is 100% delegated. And what that means is if there was an instance where you came to us and said, I really need this done in 3 weeks or 4 weeks or 2 weeks, I would recommend the Fannie Mae process because we can approve that loan and get to the closing table a little bit quicker than you may potentially be able to on the Freddie side.
What are the things that, Fannie has a box, and if it's in the box, it's delegated. What are the things that are outside of the box that you would typically, or, on a common transaction, have to go to Fannie Mae for approval?
That's a great question. So one of the largest instances where we're going to Fannie Mae is on pricing. So we are consistently, I'd say, 80% of the loans we are planning on going into Fannie Mae on pricing. Second largest one that they see is on scattered sites, actually. So they'll constantly, people are asking them if this would work under one loan or if it had to be two separate. A third one where people will go to Fannie Mae is on IO. So certain Fannie Mae lenders have certain levels of delegation, others don't. It's always important to make sure that your Fannie Mae lender has the ability to do some things because honestly, not every Fannie Mae lender is created equal. So one of the instances where typically you'll see Fannie lenders go to Fannie Mae is for IO because you're only delegated 1 year on the delegation before you need to get a Fannie Mae waiver.
Give me an idea again on leverage between Fannie Mae and Freddie Mac. What's the leverage amount that you can do in Fannie Mae, and what's kind of the breakdown of the leverage amount on Freddie Mac?
So on a top market Freddie deal, you can go up to 80% provided you have the coverage on both an acquisition and a refinance. That's going to differ on the Fannie Mae side because Fannie will allow you to go to 80% on the acquisition. However, they are going to cap you at 75% on the refinance. From there, as you start to go into more secondary, tertiary markets, Freddie is very programmatic. So 75% on the acquisition, 70% on the refi. However, again, another reason why not every Fannie Mae lender is created equal, as you start to go into the secondary and tertiary markets on Fannie Mae, what you may find is that one lender may be comfortable at 75, another may be comfortable at 70. There's a little bit of variance on the Fannie Mae side.
And then you also need higher coverage, too, on these smaller markets.
That is correct.
Instead of 125, it goes up to 130 or 140?
Especially on the Freddie Mac side. You'll see, again, very programmatic, 130, 140 potentially.
Again, James, what does that mean when I say 125, 130, 140? For people that have never done it before, I love sitting here with two underwriters. James, as you know, 10 years with GE Capital as an underwriter. John has been doing this for a long period of time as an underwriter. But James, what does that really mean?
So the easiest way I think to explain it is, let's say your principal and interest payment is $100,000 a year, and the lender, they're going to underwrite the deal, and if your NOI comes out to $120,000 divided by that $100,000, that would be a 1.2 debt service coverage, and that is what the lender is going to size to. So if your NOI is $95,000, then you're not going to get that loan. Right. So as your debt service increases, that gives you more loan proceeds, and then they size it typically right at that level. So 125, 130.
Yeah. So some of these smaller areas, they'll do the transaction, but they're going to require having the asset, the property that's generating the cash flow, have a lot more income to what the debt is.
Right. And I mean, what we've seen is, when I started in 2015, 2016, deals were constrained actually by LTV because you had higher cap rates. You had 7, 8, 9% cap rates versus interest rates of 4 and 5%. But now that cap rates have come down, compressed since then, most of these deals are debt service constrained. And so let's flip over back onto my chart here. I wanted to talk about prepayment penalties and how Fannie and Freddie treats those, whether it's step down or yield maintenance.
Great question. So both programs, Fannie and Freddie, have yield maintenance option and a declining prepay option. Fannie it's basically those two. That's all you really will see on Fannie Mae. On Freddie Mac, they have a few extra options that you can elect if you are looking to do a more escalated prepayment. So on a 5-year, for example, the standard declining prepay 5, 4, 3, 2, 1 for each consecutive year of the loan. However, if you came to us and said, I really am thinking about exiting this loan within 2 years, do you have an option where I can minimize my prepayment penalty in year 3? We offer, for an additional price on your interest rate, I can do what is known as a 3-1 and done. So 3% year 1, 1% year 2, and then you're open in year 3 so that you don't
I think that's what, 20, 25 basis points to do that?
That's correct, approximately.
So that's not bad.
Yeah.
So it's almost like a bridge loan, so to speak.
That's exactly it.
Where people can get in, execute their plan, get out, and don't have to worry about being tagged on the getting out of the transaction.
Correct.
And the large yield maintenance or prepayment penalty.
And if you think about it, it is actually a very good alternative to a bridge loan because, again, low costs, non-recourse paper, and you can exit for free in 2 years.
I guess the only constraint on that compared to a normal bridge probably would be leverage.
That leverage, or what we usually find on the bridge side, is some of these deals are coming to you with a heavy lift.
So the value add piece
a lot of value add, so the cash flow may not support the full leverage that you're looking for.
Okay. And then the next thing here on my checklist is green. Do Fannie and Freddie offer that? And what are the requirements? So
on the small loan side, so just speaking to that specifically, Freddie does not incentivize any sort of green rewards or green value add or lead certifications. Fannie will, though. So what that entails is going out and getting a high performance building report and identifying areas where you can save on both electricity and on water consumption. We don't do as much of that, honestly, on the small loan size because the savings on the rate is somewhat minimal. So think about 11 basis points or so on a 10-year piece of paper. So we just don't see a lot of people asking for that, given that in order to identify what would be about 15% savings in electric, it could be a significant outlay up front to realize those savings.
Loans are assumable?
Both loans are assumable.
And again, it's only the Fannie Mae loan that has that supplemental
That is correct.
option, which is like a cash out, whether refinance or cash out to help get higher leverage when you go to sell the property and somebody wants to assume the first lien. And then talk a little bit about the difference between tax escrows and replacement reserves.
So again, Freddie, very programmatic. Above 65%, they are going to require that you escrow for property taxes, and insurance and replacement reserves are waived. On the Fannie side, it's a little less programmatic, so they're constantly going to be looking for the property taxes. They're also going to be looking for the replacement reserves and the insurance. However, there are certain points where they will negotiate with you. This is where you may come in, they may ask for some sort of level of partial recourse if you, for whatever reason, do not want to reserve for replacements above a certain LTV, call it 70, 75%, or if you don't want to reserve for the property taxes or the insurance. So again, Freddie, very programmatic. Fannie, there's a little bit more flexibility, but for what I like to tell people, 65% is kind of that rule of thumb where they're going to look for the difference, or they're going to look for escrows.
So everything we've talked about is sort of fixed rate financing. Do either of these offer floating rate loans?
Yes. So Freddie will offer a fixed period and then a float period after. So think 20-year term. I can fix for the first 5, 7, 10 years, and then I can have a floating period thereafter. In terms of a straight up floater from day one, they do not offer that. Fannie, on the other hand, will offer you a straight up floater if you want to from day one. But they both offer what is known as a hybrid product. So fixed to a float at over a 20-year term.
Talk a little bit more about rehab. I know that we talked a little bit about that. Rehab for the Freddie Mac small balance, we cannot add that into the loan. It doesn't work. And so any rehab that has to be done has to come out of the borrower's pocket, the guarantor's pocket, into the transaction. So if you're doing a little bit of a stabilized property that has a little value added, Freddie Mac is going to require you to put some of your own cash to do the rehab on the property. Fannie Mae, what do?
Fannie Mae will finance some of the rehab. So what we're going to look for is an appraisal that shows the value as is and then as stabilized or once the rehab has been done. And what we're going to do is work with you to figure out your budget. I mean, what's the story behind the deal? And obviously work with Paul and James here. What is the business plan, right? And, each deal at the end of the day is definitely an individual deal. So we always want to work with the sponsor to understand what their business plan is and what the story is. And then we can work with you to see, all right, listen, the property supports X amount of additional cash flow, so we can go up to 90% of cost up front. Here's the budget, and potentially we may hold back some, we may fund more, but the nice thing is that there is a level of flexibility on the Fannie Mae side, depending what the deal looks like and what the business plan is, to finance some of those construction costs or value add costs.
Yeah, I mean, I think some people get this confused, and let's take an example. Maybe let's say there's $100,000 in CapEx that you're planning on the property, and the lender essentially is going to put up, let's say, 75%. So that $75,000 will be added to your loan, but it's going to be held in escrow. And then you, as the borrower, are going to put up the other $25,000. So now you have $100,000 in that escrow. And how does that $100,000 come back to the borrower?
So the borrower goes ahead and he will perform the work. And what will happen then is he will send us invoices and confirmation that the work has been done. Usually the confirmation is through pictures, but it's not uncommon where they say, we want to inspect the property. And once that has happened, then we will release the funds to you. So the sponsor's putting up the money first, and then we reimburse them for that.
Talk a little bit about, at least on Freddie Mac and Fannie Mae, and sometimes people don't understand, is that what we do is an appraisal on that property. So we determine what the value is of the property. We do a phase one and see if there's any bad soils or chemicals underneath that property. But then we also do a property condition assessment report. It's kind of the eyes and ears for Fannie Mae, really to check for health and safety. And sometimes you go on the property and the engineer says, hey, listen, we got something that it needs to be repaired and something needs to be fixed. We want to have that done soon, and we want you to take care of it after the loan closes. Talk a little bit about that.
Sure.
Because a lot of people don't understand what repairs look like.
Yeah, I mean, this goes back to one of our original points. I mean, this is a non-recourse loan, so we care a lot about the collateral. Obviously, we care about who the sponsors are and their business plan, but again, we want to first and foremost make sure that our collateral is well maintained for 5, 7, 10, 12 years, however our loan is outstanding. So we're going to pay for an engineer to go out there up front to let us know what may need to be done over the life of the loan. So think, hey, there's 5 years of usable life left on your roof. You're going to have to start thinking about replacing that within 5 years from now. Or the parking lot, we commonly see this parking lot needs to be repaved. So on the Freddie side, what we will do is we're going to figure out what that cost is. We may ask you to go out and get some bids for what you think that cost will be. And then there'll be, depending on what that dollar amount is, we may hold back, or we may say, all right, we're looking for you guys to do this repair within 12 months. On the Fannie Mae side, because there's replacement reserves, again, think a little bit more flexibility here. So if you want the ongoing reserves to be a little bit less, we may opt to have a little bit more held up front in an escrow account so that we know when that day comes, the money is there and the work can be paid for, and then we can reimburse you for that work. So there's a little bit more flexibility on the Fannie side.
You've done a lot of transactions. Maybe pick one or two transactions in the last, let's say, 6 to 12 months where maybe there was a challenge either on the borrower side or the property side, and sort of how you overcame that. And if there's any maybe takeaways for borrowers doing their first transaction, maybe some lessons learned as well.
Sure. Yeah. We had a deal come to us. It's a low leverage deal. And low leverage is always great. You don't see those very often. Sponsor wanted to do a little bit of structuring on both the IO and also potentially on the terms of the loan. So that was one where we naturally pushed them a little bit more towards the Fannie Mae side, gave them great execution and a rate that I have never seen in my life on a 10-year fixed piece of paper. But Freddie is not going to let you negotiate terms on the loan docs. Fannie will, for...
I'll put quotations in my fingers. That's not really going to happen. I mean, they will tell you that some parts are negotiable with Fannie Mae, but they're not.
Correct.
And that's just not going to happen. Talk a little bit about challenges with managed versus self-managed.
Great. That's a great one. I was going to go there. A lot of sponsors that are getting into the business, we are commonly fielding the question about third-party management versus self-management. And I think we all understand that no one really takes care of your property quite like you would take care of your property. However, our primary focus is on our collateral here. So we want to make sure that you as a sponsor or an individual have properly, taking care of other properties, or you have experience managing, call it a 30 or 40 unit property. So what we are telling people more and more these days, and when we talk to Fannie and Freddie, it's kind of along the same lines. With limited experience, we can get more comfortable in good primary markets on properties that have been well maintained and there's not a lot of work to be done on them. So by that, I mean, the Dallas, the Houstons, the Austins of the world, where you're buying a property that the previous owner did a lot of work on, shows very well, and it's stabilized. There's not a lot of variance in collections, and it's buying the property for a good cash flowing asset.
Yeah. So you also want to live within 50 miles of the asset
Correct.
Itself. They would want you to maybe have some experience of maybe having ownership or management of other properties. So they want to see a little bit of your resume on what you've done. Single family, maybe not included in that resume, but if you have ownership in other multifamily properties, even as a passive, if you've taken some educational classes on multifamily and you've had some great mentors, maybe they can, you can put their names down of other deals that you've kind of have been helped through on that stuff. But I would tell you that typically we do not like you managing your own properties. There's so many things that can go wrong. The biggest thing is accounting. If you're not an accountant, and because remember, you got to turn your financial statements over to Fannie Mae and Freddie Mac how many times a year?
We're looking for financial statements once a year and rent rolls every 6 months.
So you got to turn that information over to Fannie Mae and Freddie Mac just to have them understand a little bit of how you're coming along with the transaction. They're also going to want to see your personal financial statements, your balance sheet. They want to see how you're doing too in the transaction. That's one of the things that you sign to make sure that you're continuing to have some liquidity in case of a rainy day. So we would kind of prefer not to have you self-manage, take on a new job, but you could if you've checked some of these boxes that you live within 50 miles and this is a transaction you've had some experience with in the past.
I missed this earlier, but going back to my chart, first-time investor, how does Fannie treat that versus Freddie Mac?
Again, it's, we want to understand the deal. We want to understand the collateral, that investor, what his experience is, where he lives, his financial wherewithal, so his net worth, his liquidity. If I had to pick one bucket, I would say Freddie is going to handle that better than Fannie Mae. That being said, though, it's largely going to come down to the narrative, right? So what is my collateral? Where is it located? Who is my sponsor? So it's definitely a conversation to be had with us, and we can steer you, but we do first-time investors, and I'd say more than likely it's going to be a Freddie Mac.
And then third-party property management.
And third-party property management. That's correct.
Talk a little bit about principal requirements. We talk about sponsors in the deal. What are we looking for from them? Net worth, liquidity, FICO scores, bankruptcies in the past. Give me an idea of what we're looking for principals.
Sure. So net worth and liquidity are largely the same. We're going to be looking for on the net worth side between all of the sponsors. So, if there's two sponsors, cumulative, we're looking for roughly net worth equal to the loan amount you're looking for. And on the liquidity, we're going to be looking for 9 months of liquid assets in debt service post-close. So by that, I mean, if your loan is $100,000 a year to pay your mortgage, We're going to be looking for $75,000 in liquid cash, checking, savings accounts, and readily marketable securities that you can liquidate within a day. 401ks do not count. IRAs do not count unless you are of retirement age where you can draw on them without a penalty. Life insurance does not count either. So
tell us a little bit about foreign investors.
Yeah. So foreign investors, and one other thing I did want to touch on. So FICO scores. So FICO scores below 650, not going to happen. Fannie Mae is a little bit more stricter there at 680. So getting a credit exception for a FICO score below 680 on Fannie Mae is extremely difficult. But below 650, it's really very hard to do.
Bankruptcies in the past?
Bankruptcies, depending on how long ago it was and what it was related to, you can get a little bit more comfortable with. So we have done bankruptcies with sponsors for, various different reasons. So again, it's going to come down to the narrative on bankruptcies. Felonies, not going to happen.
Well, how are they going to know about a felony?
We run background and credit check, and felonies never go away.
All right. Talk about some of your friends from Canada or Mexico or Japan or England that want to invest in the United States.
You can do what we call foreign guarantors or foreign nationals. We are looking for them to reside in the United States, even though they may not be U.S. citizens. So that's going to be the first thing. The second thing is we're looking for a net worth and liquidity to be roughly double. So 2 times the loan amount and call it about a year and a half or so in liquid assets. And we will try and run as much of a creditor background as we can. But you can do foreign nationals, and it's not uncommon. We do them fairly often.
So if I have somebody from Spain that actually lives in Spain but wants to buy a property in Virginia, how difficult is that to get done through Freddie Mac?
Difficult. Unless there's, he's partnering with someone here in the United States.
So the key thing is really partnering with a U.S. citizen.
Or unless, he's, billions of dollars of U.S. assets and he still lives in Spain. But it's going to be very difficult if you reside outside of this country.
And you want to make sure that U.S. partner that he chooses actually puts money into the deal and is just not a hired gun to sign, right?
Yeah, that's correct.
All right. Talk a little bit about scattered sites. What does scattered sites mean to somebody?
So on a scattered site deal, what you're looking to do is link a few properties that are not contiguous or not next door to each other onto one loan. The benefits of doing that would be if you have a few different properties all on the same block or street that you operate as one property, bought them as one property. The cash flows are all integrated together. You have them on one blanket insurance policy, and you intend to sell them as one property. Then we would run those as a scattered site deal. Both Fannie Mae and Freddie Mac have different nuances to how they look at those, but they largely will entertain those depending on what the story is. So Freddie's going to be a little bit more conservative sometimes on your loan to value and your debt service coverage ratio, but Freddie will also do deals that are 3 miles apart. So it's basically when you have that, approach Paul or James what the instance is, and we can quickly let you know which avenue to take.
So can I get 100% interest only on some of these loans? What's the leverage point on that?
65%. So as long as you're staying below 65%, or what I'll say 135 debt service coverage ratio, you can do a full term IO deal.
Mm-hmm. And how long does these loans typically take to close?
I mean, we've done them as quick as 25 business days, but on average, I'd call it 60 calendar days or 2 months.
Mm-hmm. And what do we usually typically need for somebody to get a quote in these deals? And how long is the quote good for and all things like that? Again,
business plan is always great. Why are you buying this property? What do you like about it? What is your plan for this property? But then in terms of financials, we're going to be looking for a rent roll and historical operations, T12, a P&L statement. If you have a broker package, if it's an acquisition, those are always helpful. And then a narrative on the sponsors, who they are, where they live, net worth, liquidity, and any sort of prior experience, REO schedule.
How many people are refinancing versus purchasing? You know what the breakdown is with Fannie or Freddie on these small loans?
It's pretty split. Given where rates are today, we are seeing a fair amount of refis. We had not expected the 10-year treasury, which is largely what drives a lot of our rates, to be this low at this point. So we're seeing a fair amount of refinances, but we're also seeing a fair amount of acquisitions. It's that deal that didn't make sense at the 5% interest rate now makes more sense at 4.25%. So we are getting a fair amount of interest on the acquisition side as well.
And you can pull some cash out, right? Tell me
That
a
is
little bit
correct.
about, again, I think we touched upon it on a refinance, but again, if somebody's interested in refinancing one of their bank loans, and you can pull cash out on Freddie Mac up to what leverage?
So Freddie will take you up to 80%. It's dependent on the market, right? 80%, 70% if you're in a secondary, tertiary market on the loan to value. The one thing I will caution you on is in less than 2 years of ownership, both Fannie Mae and Freddie Mac are going to, again, ask for the narrative work that you did. They're going to want to see a trend on your income, and they're going to look at your cost basis. So they're going to want to know what the story was. So there's really no easy answer for less than 2 years. After 2 years, it's going to be a lot more on loan to value.
So again, I think James asked the question about just, who's good for these programs? Give me your last one or two transactions that we closed with without saying names, but give us an idea in a Rolodex for somebody to remember.
So we're doing business with a lot of gentlemen and ladies that, have one or two passive investments and they're looking to get into more of the active side. We have a sponsor we probably financed 40 times last year who's probably got 5,000 units. We tend to see a lot more of the newer investors to this space that may not have more than 200 units, 100 units or so, but that's kind of the bread and butter of what we see.
And when you refinance it, typically they want to refinance their entire portfolio. Like you just refinanced the portfolio of how many buildings?
That was actually an acquisition, but it was 18 buildings. We're doing a refinance right now of 13 buildings.
So when people actually do this type of a program, they want to kind of either refinance or buy, and they want to stay with one lender doing one program. And so
Correct.
That they understand all the paperwork that's involved.
Yeah.
So the Freddie Mac loan really is a competitive to a bank type of a transaction. So sometimes I wonder why people actually will do regional or national bank financing for apartment buildings. It's hard to think about why they need to do that. Sometimes it's because rehab that needs to be included in the loan, a shorter term maybe that be necessary. But I think the Fannie Mae small balance and the Freddie Mac small balance is perfect for so many people.
Correct.
Yeah.
Correct.
Any final sort of advice for those investors who they say, all right, yep, I get it. Fannie, Freddie, I'm going that way. I like the non-recourse piece. What is your advice? You've done a ton of transactions to getting these deals approved and closed on time.
Well, the first piece of advice is work with a great team like Old Capital. The market is volatile right now. There's constantly lenders that are coming and going. And again, not every Fannie Mae lender is created equal. And not every Freddie Mac lender, honestly, is going to give you the same quote. So having a trusted advisor like Old Capital, I think, is your first step. After that, it's let us know what you're working with, right? It's unfortunate, but it happens sometimes where you get down the road and then something comes out and you really didn't plan for it. So the quicker you can let us know where the quintessential bodies are buried or the skeletons exist, the easier it is for us to handle that and to work with you, because we all, at the end of the day, want to make good loans and we want to understand what the narrative is, who the sponsor is. Fannie Mae and Freddie Mac are both great partners of ours, and we want to work with them and work with you to do the best we can to help you succeed.
How big is Red Capital?
I think the servicing at Red is north of $20 billion of loans.
So they've seen everything.
Yeah.
There's no surprises.
Yeah, John's been around for a long time. Is that if you have a chance to go back into the Old Capital podcast and download our Multifamily 101, you definitely wanted to get online and download that. And John had a big part of helping us kind of formulate some of the information for the small balance Fannie and the small balance Freddie. So go to oldcapitalpodcast.com, download that white paper report. We appreciate that. John, thanks for being on the podcast. We appreciate your time. And James, always a pleasure.
Thanks a lot, guys.
I'll talk to you soon.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.